Americans are throwing in the towel on credit card debt. Well, it just keeps getting worse and worse, doesn't it? For months now, we've been talking on this channel about the state of consumer debt in the United States. We've reported on high credit card balances, an all-time high in delinquencies, how Americans' credit scores have fallen for the first time in decades. As always, the mainstream media is putting a positive spin on this, the corporate media, saying the economy's strong or that these trends aren't severe enough to signal financial distress. But more and more data are confirming the truth. We don't need to pretend this story has a happy ending or come up with a narrative that makes people feel better about the mountains of debt. This credit card situation is destroying Americans right now. So don't be surprised when you hear that the new Fed data that just came out show that the growth of the credit card debt actually slowed in the first quarter. Sounds like good news, right? And it will probably be regarded as such in an echo chamber of corporate media. The truth is that while the growth did slow, Americans still added over $6 billion in liabilities to their column in Q1 in the form of consumer debt. That's right. And we just got the latest CPI numbers that shows that consumer prices continue to rise. So Americans are going to go further in debt because the cost of everything has gone up. Shouldn't be surprising to anyone that credit card growth is finally slowing down a bit, especially since the average APR for commercial credit cards hit a new record high over 21%. So could that be a reason why? These numbers have gotten so high that Americans are saying, I just can't do it anymore. I just can't do it. So it's a perfect storm right now. High interest rates, inflation, student loan payments resuming all at once. A spending slowdown is inevitable. It's not sustainable to keep spending and spending money that you don't have, but tell that to the federal government, which is $34 trillion in debt. They can print money and you can't. In fact, right now, 1 in 3 Americans have maxed out credit cards due to the effects of inflation, according to a new survey by Debt.com. Meanwhile, more and more banks are recording rising charge-offs and delinquencies quarter after quarter. Credit card debt is still at a record high. Let's not pretend that everything is suddenly fine here. So when you see reports on TV or you're reading your liberal newspapers and you're saying, oh, and it says consumer spending will normalize, it begs the question, how exactly? Because there is no good ending to this type of trajectory. I mean, take a look at this chart, for instance. This is unbelievable. This is from Zero Hedge, showing Americans' savings balances in green, the total credit card debt in red. This chart really sums it all up. Americans are drowning in credit card debt right now, with little to no savings to speak of. The personal savings rate has plummeted from over 5% to 3.2%. This is the lowest savings rate we've seen since 2022. This is absolutely frightening. The gap between these two lines continues to grow, and credit cards eventually max out with continued spending. So how will people survive when their credit cards are no longer an option? Maybe I'll point you to my other video that I just did where I really dive deep into how they plan to drive the US dollar into the ground on purpose. I know it sounds conspiratorial, but when you understand the goal as a CBDC, a central bank digital currency, and the key to get there is to create a financial crisis so that the U.S. Treasury-backed U.S. currency collapses. That's how it's going to happen. We'll get back to the video in a second, but look, your money is not safe. You can see all the time that stocks can crash, bonds lose value. Anything that you can't physically put your hands on increases your risk right now. Hey everyone, I'm Clayton Morris, longtime real estate investor and founder of Morris Invest. And my favorite tangible asset is real estate. It consistently outperforms other asset classes. And I believe it's the #1 way to build and protect your wealth. Now, while there are several ways you can invest in real estate, most of which I've tried myself, the build to rent model offers the most benefits. More specifically, single family buy and hold rentals. Here's why. Much lower risk than trying to flip a house. You have more control and higher returns than REITs. If you're investing in the stock market, it's way less work than wholesaling properties if you're into wholesaling. Many fewer repairs and headaches than trying to rehab a property. My company, Morris Invest, along with the help from our partner at Sedera Wealth, helps you invest in build-to-rent properties as easily as investing in stocks. That's because we buy and build in bulk, and then we pass on our savings to you. And when you purchase a property through us, you get discounted pricing on properties at or below market value. Seller incentives like mortgage buy-down rates and credits right now usually lowers your rate by about 1%. And we know with higher interest rates right now, you definitely want that, right? And you get free ongoing customer service for the life of your investment. Get personal phone numbers and email addresses of our team. And build-to-rent properties are in prime growth markets. We're talking 18% internal rate of return. 18%. Amazing tax benefits. And you get a free cost segregation report, helping find strategies that increase tax write-offs. You get principal reduction as your tenant pays down your mortgage. And you get steadily growing appreciation and equity gains. Plus, positive cash flow. We won't sell you a property if the math doesn't add up. If you want to know more, just click the link in the description box and it'll take you to our website where you can book a free call with our team. There's zero pressure, no obligation. Look, I understand we won't be a good fit for everybody, and that's totally okay. Some of you might want to be DIY, you want to do it yourself. That's great. Either way, you're going to walk away from our phone call with some valuable new insights and an idea of what questions you might want to ask and some actionable steps that you can take to move forward in your financial journey. You can always find an excuse to not invest, but the sooner that you start a smart investment like build-to-rent real estate in a strong market, the sooner you'll be enjoying pure cash flow. So click the link below and I hope to see you on our schedule. We also know that inflation and recessions right now are incredibly difficult hurdles for people with lower credit scores. And rising interest rates make it extremely difficult to pay down credit card debt right now, especially for those who are just trying to make ends meet. Now, a new survey that just came out from Ipsos found that 35 to 54-year-olds rely on their credit cards for emergency expenses at twice the rate of those over 55 years old, which may be unsurprising given the fact that less than half of the younger Americans said they had enough money saved for unexpected expenses, compared with 70% of those over 55. And of course, we heard during the pandemic how a lot of these older Americans were able to swoop in and buy homes out from these millennials who were trying to buy homes because they had that liquid cash. They had that cash available. They had that backup plan in place in order to make these purchases. So all these millennials that didn't have that extra cash were getting screwed by the older Americans. And now they're relying on their credit cards more than ever. So the Ipsos Consumer Tracker also linked these generational gaps in spending and saving habits to an important factor that we should all consider: financial literacy. Yes, that's right. The sooner we're honest about how dire the situation is, the more likely it is that people will be able to develop the financial education they need to get out of credit card debt. I mean, credit card APRs are at an all-time high. And there are many consumers out there that don't know what their credit card APR even is. It's criminal to charge over 20% for interest. The entire credit landscape is a minefield designed to trap people with high interest rates and low minimum payments. This is a system created to damage young people, low-income demographics, and frankly, anyone who is down on their luck or doesn't have the financial intelligence to know better. So for more on the consumer debt crisis, we've got to watch this next video where I take you through the specific action steps that you can take right now if you're stuck in this credit card cycle. And we'll see you in the next video.